Hello, I'm Bernard Hickey from Interest.co.nz and welcome to another in our series of double shot interviews. That's where we get in a minister or a CEO or a fund manager or someone who's doing something interesting in the world of economics and finance to talk about the stuff that we find fascinating. And at the moment, that's what's happening on the global financial markets. And here from London, we have Simona Paravani, who works for HSBC, managing funds across the world and in different types of asset classes. And it must have been an exciting couple of years managing funds with what's been happening in the global financial markets. Welcome to Interest.co.nz.
Welcome. Well, thank you for inviting me. It's certainly been a very exciting time, and it continues to be a very exciting time.
That's right. So what's your overall view on what's going to happen to stock markets, bond markets, commodity prices over the next year or so?
Well, before we can actually look ahead, perhaps we should really take a pause and see what has happened up to now.
Sure.
If we look at the performance of financial markets, overall is really not that bad. I mean, we look at global developed market equities, they are down by about 2 to 3%. Fixed income, despite all the concerns around the so-called PIGS, the reality is that the riskier segments of fixed income have done reasonably well. So the interesting point here is really that despite the numbers that are not that bad, the performance of financial markets year to date actually feels a lot bumpier than the numbers really seem to suggest. And why is this really the case? Because of the very high level of volatility and uncertainty, which has characterized market performance. Now, if we look ahead, the key question for us as investors is really, is this uncertainty, is this volatility likely to persist? And I would say that the answer is definitely yes.
So where do you put your money when everything's so volatile?
Well, the key answer to really addressing the volatility point is a very simple yet very powerful one: diversification. I know that it's not as exciting as, say, buy X or Y, but the truth is that sometimes the most powerful things in life are really the simplest. And diversification implies some very interesting maths, but at the end of the day, it boils down to something that you and I and everybody else do in our everyday life, which is don't put all your eggs into one basket.
So where do you spread your eggs, into which baskets?
When we talk about diversification, there are a lot of very different dimensions. First of all, and very important, is geographical diversification. And by this we mean really the importance of having exposure to both developed market as well as emerging markets. And that's extremely important because it's a way of capturing really growth in exciting parts of the world. When we talk about geographical diversification, we mean that not only in the context of equities, but also fixed income and also, very importantly, currency. The second key point about diversification is really asset class diversification. Traditionally, investors have focused on either equity or bonds, but the reality is that nowadays there are many more asset classes that investors can use: private equity, hedge funds, to name but a few. And why is this important? It's a bit like cooking. I mean, you can decide to cook with only 2 ingredients, but you have many more at your disposal to really generate the type of meal that you're after. The third and very important point about diversification is really manager diversification. Once again, the key is really to try and combine as many managers as you possibly can so that your portfolio is really not exposed to the performance of any particular manager or any particular style. And very importantly, like in cooking, once you have selected all your ingredients in terms of markets, in terms of asset classes and managers, make sure that you have the right people to put them all together.
So we've had the last couple of years of volatility, and now we face the problems that the central banks have with getting economies going again. What's your view on whether we can get out of this mess that we're in at the moment, where economies, particularly the developed economies, are really struggling to get going?
Well, if we look at our central scenarios, one of moderate but positive growth, where emerging markets will continue to be really the key motor of economic growth. The problem with this scenario is, where are the risks? And the risks to growth are largely to the downside. And that's really linked to the issue of debt. And when we talk about debt, we talk both about private, in other words, family debt, but also increasingly important and in the spotlight, government debt. What is very clear when we look at the issues of debt is that sooner or later, both families and governments will have to start saving. In other words, they will have to really reapply the good principle of the good housekeeper. And when that happens, it's going to reduce the potential economic growth. So what we really should be facing and should be prepared for is a period of slower potential growth in the developed world in particular.
But I don't quite get it. How is the developing world going to keep growing when it won't be able to sell so much stuff to the developed world?
there is certainly a strong structural change going on in the emerging world. So once again, the emergence of sort of consumption, domestic demand in those parts of the world, such as China and Brazil, is an important driver of future economic growth that should really help to rebalance the dynamics in terms of saving and consumption between the emerging world and the developed world. So we see this as a fairly important structural development for the global economy.
Because that's the problem, isn't it? We need the developing world to become more consumer-focused and less production-focused, yet we have governments in China and India and various other places that seem very keen on keeping their currencies low and firing up their export engines. I wonder how that's going to end. How do we fix the structural problem?
Well, first of all, we are seeing some changes in terms of the ability of consumers in those markets to improve their standard of living and consume more in terms of, for example, we have seen some significant increases in wages in selected parts of the emerging world. So that's already a sign of a sort of development in terms of higher purchasing power by the local consumer, which is quite important. In terms of the currency position, our recommendation here is really to take a long-term view. And when we look at what drives currency over the long term, that's really economic growth and its improvement in macroeconomic fundamentals, and that's both in terms of balance of payments but also generally the monetary policy framework. And when we really look at those factors, it's very clear that emerging market currencies should be appreciating over the medium to long term. So one of the key recommendations that really we make to clients, no matter where they are based in the world, is really to make sure that they have exposure to emerging market currencies because over the long term that's going to be beneficial.
What's your view on the US dollar and whether it will keep its reserve status?
Well, when we look at the US dollar or any of the major sort of other currency in the developed world, such as the pound or the euro, what's striking is how much they have in common. I mean, they're all faced with significant issues around their ability to grow over the medium to long term. They're also all facing issues around the level of government debt. So when we factor all of this together and couple with that the fact that interest rates are still low and likely to stay low for quite some time, what's interesting is that there is an awful lot of commonality. So in our view, it's not so much an issue of US dollar vis-a-vis some of the other potential reserve currencies such as the euro. It's more an issue of let's call it developed world currencies vis-a-vis the emerging markets. And the big story there is really the emerging market currencies are likely to appreciate on a medium-term basis.
And the euro, everyone's looking at what's happening in Europe, and you're based in London, so you must be watching it very closely. Do you think the euro will survive the next few years?
At the moment, it definitely seems to be surviving. There are structural issues that in the Eurozone will need to be faced, and what we have seen in terms of the debt crisis around Greece has really highlighted some of the structural issues that need to be addressed. But everybody also recognizes some of the key benefits in terms of the monetary union. So as with most institutions are not static, they evolve through time. So more likely than not, what we'll see is the Eurozone evolving its institution in line with the needs of the local economy.
Commodity prices have zipped up, come down, back up again in the last couple of years. What's your view on the future for commodities such as oil or even gold?
Commodity is a very important asset class to a well-diversified portfolio, not least because it can really act as an inflation hedge should there be inflation surprises in the next few years. So we really recommend that clients should have exposure based on the diversification argument first and foremost. In terms of the more tactical views, again, it depends from commodity to commodity, but we certainly see a very interesting structural growth story there, once again underpinned by emerging market growth.
What do you see as the main risks for the global economic financial outlook in the next few years? What worries you when you get up in the morning?
Well, the sustainability of the current economic recovery is a big question mark, and how we are going really to address the issue of high levels of debt, both at the consumer level and the government level, is going to be very strongly linked to the overall growth picture. So it's unquestionable that we do have significant challenges. And as long as these challenges stay on our horizon, what we will continue to see is a lot of volatility. So our key recommendation to investors is it's important to invest because interest rates are likely to stay relatively low. So if you want your money to work as hard for you as you do to earn it, it's important to be in the market. But at the same time, it's equally important to be in the market in a fully diversified way because volatility, I'm afraid, is here to stay.
Simona Paravani from HSBC, another in our series of double shot interviews. Thank you very much, Simona, for coming in to interest.co.nz.
Thank you.